Good afternoon, everybody. Thank you for being here and on time. Look at this. We got quite a turnout today. Why don't we just give it a couple minutes, maybe one anyway, just to let the stragglers get in and we'll get started. I commend you all for being here. I recognize some of these names. Some of you are new. I'm excited to be sharing with you about this loan product. It happens to be my absolute favorite loan product for those individuals that make sense for conceptually what this is and what it does. And we'll get into who it's good for and who it isn't. But there isn't another loan that I'm aware of that rivals this. So excited to be giving you guys a peek at this and unpacking what it is and what it can do for you. All right, let's just give it to 12:01. All right. And while we're waiting, let me just kind of set the stage. I think, and Michael, if you want to chime in, I think everybody that has registered for this, they will automatically, I think Teams will automatically give them a copy of the recording, right? Do you know?
Yes, and if not, we'll make sure everyone gets a copy of it.
Okay, so there's a ton of information here, you guys. There's a lot to unpack. If this is the first time, and I'm going to be talking about this as if for brand new beginners. Okay, so for those of you that might be a little bit more versed in this concept, some of this might be redundant. I think it bears repeating many times, but for those of you that are brand new, there is a ton of information to unpack, and chances are very good that this is not the first time that you're going to need to hear this to really connect those dots. I'll share with you just briefly. So I've been in finance for over 25 years now. And when this loan was first introduced to me, it's probably been 18 years ago, I struggled. I really had to spend a lot of time looking at this and reading it and listening to it and over. Repetition was my friend until I really understood. So I would just caution you, be patient with yourself. It will come. And we'll take one-on-one time. For those of you that think this is going to be a good fit for you, make sure that you get with us, info@ridgelendinggroup.com. I'll repeat that at the end of the presentation as well. But make sure you get with us and get on my schedule. We'll do some of the interactive simulators that I'm going to do here today together as it relates to you and your numbers, et cetera, to see where you fall in line with, is this a good fit? Is it not? Okay. So let's just get started. I'm going to just quickly set the expectation. What I'm going to do here today, gang, is I'm going to start by giving you the basics. Okay, what is this? How does it work? I'm going to give you some comparisons about the all-in-one and in relation to, say, a fixed rate mortgage, just to kind of illustrate a few of my points. And then I'm going to quickly segue into sharing my screen and going through the interactive simulator, which is on our website, by the way, so you'll get to see exactly where to find that. This interactive simulator, I think, is profound in that connecting of dots, having that visual aid and kind of seeing it go through its progress and the pluses and minuses, the ones and zeros, is very, very useful in helping to understand what's going on under the hood of this loan. So we'll get into, I'll have just kind of a random example. We'll get into the simulator. And then I'd like to I'll do that kind of on the fast side. I'll try and be as clear as I can, but I'd like to leave plenty of time for Q&A, because I think that when I do these a lot, I feel like the Q&A is where people get a lot of answers that they would need otherwise, or, just to clarify things that weren't necessarily clear during the presentation, okay? All right, so without further ado, thank you again for being here. So we're here to talk about the all-in-one first lien HELOC. So what is this? I mean, it is what it sounds like, right? Everybody should probably, I would expect, know what a HELOC is, but just in case, HELOC stands for Home Equity Line of Credit. Most of you, if you're familiar with a HELOC, you've used that in a second lien position, where you have a first fixed rate mortgage probably, and then you went out and got a second lien HELOC for 50 grand, 100 grand, whatever it is, okay? The HELOC, its nature is simple interest. You take a balance and an interest rate, and you multiply those, and you divide it by 365 days in a year, and that's how much interest would accrue for the day. Simple interest, right? Versus our amortized mortgage, most of you probably know how that works. You take what you owe at an interest rate, or what you've borrowed at an interest rate, and then you amortize it over a period of time, whether it be 10 years, 15 years, 30 years, right? And as I'm talking about that, let me also quantify, most of you are probably aware that when we think about an amortized mortgage, for those of you that have actually looked at your loan disclosures before, you've seen something called a truth in lending disclosure. And you've probably noticed that if you've borrowed $100,000 from a bank, what you're going to end up paying over, say, a 30-year period of time will be what? 200,000 maybe, depending on the interest rate, of course, but it's a much, much bigger number. The reason for that is the length of time. Michael, will you get those as they come in?
Yep.
Thank you. Sorry, guys. Is the length of time that you're taking to repay that debt, right? It's time. So the all-in-one first lien HELOC is revolving, open-ended, very, very different than the closed-ended amortized mortgage. Very, very different, like a 180 different. And the concept of the all-in-one really has to do with speed. For those of you that have heard the term velocity banking or infinity banking, if those ring a bell, then you might be a step ahead of those that have never heard of that before, because the concept is very similar to those ideas or strategies. So let me take you through an example, an illustration of that speed. The all-in-one is set up so that you are able to utilize well, actually, let me back up for a second. So the all-in-one, it's called the all-in-one because we are taking two daily drivers, daily functioning features, our banking and our mortgage, and we are combining them into all-in-one. That's why it's called the all-in-one. Banking and mortgage are now married. And by changing nothing about your daily incomes or your spending habits, nothing changes whatsoever. Simply having your deposits, your banking, the monthly deposits from all sources, and we'll get further into this when we get into the simulator, dropping them into the checking account where your mortgage balance lives in the form of a HELOC, driving it down dollar for dollar, you are diminishing the balance and that interest accrual, right? I started off by saying any HELOC is simple interest, a balance, whatever that number is, and an interest rate. You multiply those numbers and you divide by 365 days. So obviously, the lower the balance on a day-to-day basis within a 30-day billing cycle, the lower the interest accrual can be, right? Versus that fully amortized payment, which is already predetermined. Okay, I'll get into more specifics in this in a second. So now I want to take a minute and kind of highlight my comment about speed. The reason that the all-in-one is so impactful and so beneficial at saving interest, and that's just the first layer of this. Interest saved with the all-in-one for many, many people, regardless of your interest rate. We'll get to that as well, too. That's just the first piece. Okay, there's so much more about the all-in-one that holds tremendous value and flexibility that hopefully we'll have enough time to get into all of those. For right now, I'm going to focus on the interest savings that the all-in-one is renowned for. All right. So for a minute, let's pivot back over to a 30-year fix. This is my illustration for speed, or not 30-year fix, but fixed rate amortized mortgage. So for a moment, I want you guys to imagine two mortgages. We have a 30-year fixed mortgage and a 15-year fixed mortgage. All right. We're very familiar with those mortgage types. Both of these loans on day one started with an outstanding principal balance of $400,000 each. All right. 15-year, 180 months. 30-year, 360 months. The 15-year mortgage locked at a rate of 7%, and our 30-year fixed mortgage locked at a rate of 4%. Now, when I go through this and I ask people, when I have these conversations, which of those two mortgages would you prefer? Almost without exception, people that don't understand amortization, they're going to say, I want that 4% interest rate, almost always. When in fact, if you do the math, you actually run the amortization table and you look at the math, that 15-year 7% interest rate will pay $40,000 less in interest than the 4% 30-year fixed. So what am I trying to tell you here? Speed. The reason that that's possible, that 7% over 180 months will save you 40 grand in interest over 4% and 360 months, it's about speed, you guys. And the all-in-one is designed, it is made to allow for that speed without changing anything about your daily habits, like I said. Okay, so I think that sets the stage pretty well. There's another entry. Let's get him in here. And feel free, you guys, put your questions in the chat, please. We'll get to those. Michael, if you think there's something timely that you see in there, if you're monitoring, that you want to ask me, and we'll pause, I'm happy to do that. But for now, I'm going to share my screen. And we are going to do the simulator. Oops. We're going to do the simulator. Okay. So this is our website. Here is how you find the simulator. And in fact, even better, we have just released a very cool all-in-one masterclass. I'm really, really excited about it. So I hope you guys check that out. Here's that cool video that I did. I think we're up to 330,000 views on that. So that was fun. I think I went viral. That was my first viral moment. Anyway, so the simulator, what we're going to be doing here is right here, start all-in-one simulator. Okay. You'll be able to save your work. I encourage you guys to plug in your numbers. I'll show you where to save your work at the end. So on the Get Started tab, and this is easy intake, okay? No vials of blood and DNA samples required just yet. That's my token joke for those of you that don't know me. All right, new simulation. When you, just so FYI in this drop down, when you save your work, you're going to get this key code to come back and mess with numbers, etc. You'll put it right in here. We're starting new though. All right, so I'm going to say this is a rate and term refinance. And I usually, if it is going to be a refinance, which by the way, the all-in-one can apply to a purchase as well. So for those of you that have questions about that, just hit me up in the chat and we'll get to it. But normally most people want the all-in-one or a HELOC because they want to tap into some equity, right? Well, generally speaking, when I start these simulations with clients, I like to start with just the rate and term, meaning we're not harvesting any equity yet. We're just stacking up what you have today against what the all-in-one could potentially do. All right. And I think for fun, what I'm going to do is we're going to do it on a primary residence. Generally speaking, I think the primary is the best occupancy for the all-in-one for the following reasons. I personally believe that accessing the highest line limit that you can is going to be to your overall advantage. And as such, okay, if we agree to that last statement, the owner occupied or your primary residence will allow for the highest leverage, let's say 80% on a refi versus 70% on a rental. By the way, we can do this on rentals, on occupied second home occupancy is it doesn't matter, but the leverage opportunity is going to be higher on a primary residence, and it's our primary residence more often than not that holds the highest value within our portfolio if you have rental properties. So we're going to start with the primary residence. You can see here that you can do any. We are going to compare it, a new all-in-one versus an existing traditional loan. Okay, if this was a purchase, you're going to do it to a new traditional loan, right? But we're going to compare it to the existing loan. We're going to say that the home value is $1 million, right? We're going to say the outstanding balance is 400,000. I'm just pulling numbers out here, okay? This individual has a 30-year fix. And let's have some fun with this. Let's say that they got pandemic rates, because that's a very common theme when I have these conversations, especially for primary residents. Clients will say, I don't want to touch my primary residence. I got a 2.5% interest rate. Okay, I get it. I get it. The psychology of that rate, I get it. However, here's my pushback. You have to do the math. And maybe you're right. Maybe that 2.5% needs to stay in place, and getting a second lien HELOC might be to your advantage. I don't know. But if you don't do the math, you're not going to know. And if you're just assuming, I think you're going to be at a great disadvantage. So trust me on this. At least do the math. All right, so let's just say we got a 2.5% comparison, and this loan is 4 years old. Okay? So what's happening here is we've got all of our data points, assuming these are correct, and this is going to be important, this age in months. Make sure that you've got your balance within a few $1,000. Interest rate obviously has to be correct, but this one really needs to be right for this to be accurate. So the math embedded into the simulator is right. If I put in that this loan was 60 months old, watch what happens here. Right, this changes. And that's important for reasons that we'll get into on the spending tab up here, okay? So the principal and interest payment, if my balance was $400,000 and I had an interest rate of 2.5% and this mortgage was 48 months old, would be to the penny $1,744.83. Principal and interest only, okay? We do not want taxes and insurance here. That comes later. All right, that's what we're looking for here. Now, if you can't get it to go exactly, you can manually input here. But anyway, we can talk about that later. If you have a second mortgage, go ahead and throw it in on this page. If you pay extra monthly extra payments, go ahead and put it here. We're not doing that here. All right, now we're on the deposits page. Now, here's the tab that I find more often than not, individuals misinterpret what the simulation needs or wants, right? And if it's bad input, then you're going to get ineffective or inaccurate results. So in the deposits page, for those of you that have rental properties, the first thing that I will tell you is that I want, or what you want to put in here, are the gross rents. Okay. Now, for those of you that have your rental properties professionally managed, we know that property management is going to take their piece first. After that, whatever is left before any cent of that rental income goes back out the door. So no payments are made, no nothing. It's the gross rents after property management takes their piece is what I want in the monthly deposits, gross rents, okay? And then I want the net of every other income source into the household. So I go overkill with this because I want to make sure it's clear. So think about your W-2, your net wages, your bonus, your commission, your dividends, your interest, your alimony, your child support, your social security, your retirement, your disability. I don't care what it is. Every source of income coming into your checking and savings accounts, we want that number to be net. Now, let's say that you are self-employed and you have an e-commerce business and you get lots of deposits throughout the month. This may be a special incentive for you to be able to see and save income. For you, you have access to all of those monies throughout the month before you necessarily have to send anything back out, right? Maybe I'll make an example of that later. Sorry, I'm jumping ahead. So gross rents, net of everything else. All right, let's just say that this individual has $10,000 a month of gross rent. Okay, they've got 5 properties, monthly gross rent, repeat deposits, plus sign down here, and net wages from the household is another 20 grand. Okay, all in. Husband, wife, whatever, $20,000 a month net. Okay, and you can see that you can add, I usually lump them together. I'm just kind of putting them in different fields so you guys can see where they go. Now on this one, so those are our repeating. That's all that I've got coming. I've got 30,000 coming in to my checking savings accounts monthly in this example. A one-time deposit, this would be for an individual that has some idle cash, okay, that's not earning much. It might just be in a standard checking or savings. So whatever that number may be, let's say you got 5 grand sitting in a savings account, okay, doing nothing for you. It could be 100,000, it could be $500,000, whatever that denomination. If it's sitting in an account doing little to nothing for the majority of the month before maybe you need it for something else, you absolutely want to pull it from that vehicle and throw it in here. Okay. Remember, interest earned versus interest saved is what this part of the conversation is about. The one-time deposit would be interest saved if you're going to take it from this vehicle and put it over here. If you're earning substantial interest wherever that money may be, clearly you're probably not going to take it from there and put it in here. But for those funds that are just kind of sitting there rainy day, this account, the all-in-one account, bank account, is an FDIC insured account. So there's nothing prohibiting you from pulling it from your Wells, your B of A, your Chase account and putting it into this FDIC insured account, whereby just saving a tremendous amount of interest. For our purposes, though, I'm going to leave this zero. Another scenario might be, let's say that you get a bonus in December every month like clockwork. If I wanted to, I could say, okay, my bonus is going to come in $10,000 and I end up saving that in 4 months or month 4. All right, so you can kind of dictate futuristically when those deposits might come in. I'm removing that for our demonstration here. I'm leaving that zero, but now you know what that means. Okay, and if you needed additional one-time deposits, there's the plus sign down there. Okay, last tab, and we'll get to the results here pretty quick. So the simulator defaults taxes and insurance to 1.5%. If you click on any of these little I buttons, info buttons throughout the simulator, it'll read it out for you. But what it's done is it's taking 1.5% of the value that we threw in on that setup page. Okay, feel free to manually do the accurate number here. Okay, I'm just going to leave that as it is. Now, last but not least, I have to look at what I've got coming in, and I have to determine how much do I have left over at the end of the month. Okay, all of my expenses, my food, my gas, my utilities, my car payment, my mortgages for my rental properties, my entertainment, everything, down to a stick of gum that's going back out the door of this $30,000. What do I believe is left over? Okay, I'm going to say for me, we're going to make that 20%. We're going to say 6 grand is what we have left over. So what this number represents is the cash flow from the rentals. Right? If I've got rental properties, some of that $6,000 is the cash flow that I get. That for me, currently, I'm not using it for living expenses. I'm going to stockpile that. And then anything else that I have left over after all of my expenses are paid. So now I want you guys, anybody that's writing or not focused, I want you to focus on this because this is important, okay? The following data points mean the following in the results. The assumption in the simulation says that we've got $30,000 coming into the checking account a month. The assumption is that $30,000 is going to sit idle for the vast majority of a 30-day billing cycle. We're going to call that 29 days. 29 days, that $30,000 is going to sit there and it will not be touched, not 1 cent of it. So I'm certain that all of you sitting there are like, okay, well, how am I going to make my bills? How am I going to pay my bills? And I probably should have said this earlier on in our discussion, but you will be utilizing an arbitrage. Okay, you're going to use a credit card of your choosing, the one that provides the best points or rebates, whatever it is, credit card or credit cards, depending on what your bills are. Every cent of your expenses, monthly expenses, are going to go on that credit card. You are not going to touch that $30,000. But you heard me just say a second ago that 29 days is how long that $30,000 is going to sit idle, right? On day 30 of your billing cycle, and the billing cycle, by the way, doesn't have to be the 1st through the 30th. Maybe it's the 15th through the 15th or the 20th through the 20th, whatever. Okay, 30-day cycle, same. So on the 30th day of the billing cycle, you're going to go online to your checking account where your 30 grand has been sitting idle, and you're going to online bill pay, and you can set this up all auto, by the way. You're going to online bill pay the credit card in full. We're not going to pay any interest on the credit card, right? That would totally defeat the purpose. So we are going to let that money sit for the vast majority of a 30-day billing cycle. On the last day of the month, we're going to go and pay the credit card off. Okay? The next numbers mean this guy right here, 1744, this is our principal and interest payment. If you recall, we got this right here, 2.5%, 400,000 balance, yada, yada. That's our principal and interest payment. The assumption in the simulator says that if we were going to replace your rocket mortgage or whatever with the all-in-one, that this amount is not going to go back out the door to pay PennyMac, and you're not going to be using it for some other living expense. It's going to sit here. Okay. Now you have one of the really cool things about this is you have 24/7 access to these dollars and cents if you needed it for any reason. But the assumption is that 1744 and 83 cents is going to be left in the account. It's not going back out now to pay that old mortgage. The next assumption is that the taxes and insurance, 1266, obviously have to get paid, and that these are our expenses. Of the $30,000, $20,988.50 have been repaid to that credit card if you're doing this right. Okay, and that finally, I have $6,000 left over in residual cash flow, discretionary income at the end of the month. So 1744 and $6,000 are left in the account month after month. You have 24/7 access to any of those dollars for any reason that you need, any time of the day, for as long as you have the loan. All right. I'm going to repeat. 30,000 comes in, it sits in, it doesn't get touched. 1 day of the month, the balance is going to increase by this number, and these numbers that go back out the door. 1744 and 6,000 are going to be left in the account month after month with full access. Now, this is a really cool feature in the simulator. I don't know if we'll have time today, but for those of you that are investors, you're really going to want to mess with this, because the one-time future expenses will allow you to have this line of credit at your disposal to draw from for 30 years to acquire property or to renovate a property or to home improve or go, I mean, whatever, it's your money. You can forecast, oh, I'm going to take $50,000 from the line of credit in month 38 and buy an investment property. Now, if you're going to do that, just quick sidebar, if you're going to be taking funds from the line of credit, the equity that's been built or is in there now for the purpose of investing, very important that you want to put the income that investment is going to yield. The problem with that, though, you guys, and this is important too, is that the simulator, and I've been asking the developers for years to correct this, and it's falling on deaf ears, but the problem with that is that you're going to futuristically take the money, but the deposits are immediate. So while it'll be close, it won't be exact. We can talk about that later. All right, enough of this. Without further ado, let's see what the results say. Okay. I'm going to make one quick change before we go into the comparison, which, by the way, quickly, we've got the all-in-one is going to be on the left. The 30-year fixed 2.5% is here on the right in these numbers. I'll get into these line by line in just a second, but I do want to make one quick adjustment. In the results tab, the sub-tab called rates and assumptions right here, the rate trend. Now, I tend to be hyper conservative when I run through these numbers with potential clients or clients in each of the categories. This one kind of bugs me, though. The rate trend defaults in the simulator to remain at the initial fully indexed rate, which as of August 1st is 8.340. And for those of you that aren't familiar with, I won't spend a ton of time. If you guys have questions about this, we can get into it. I won't spend a ton of time, but this is a variable rate mortgage. And for those of you that are not familiar with that, there are two numbers that comprise a fully indexed rate, a margin and an index. That's it. The margin is fixed. The index here is variable. You add those two together, and that's the fully indexed rate. So the rate trend defaulting at remain at the initial rate, it bugs me because the assumption is that variable rates are a straight line. It's not even possible, right? A variable rate goes up and down and back and forth and east and west. It's just not even relevant. So for me, I believe, and there's another reason that I do this that I'll show you in some of my comparison in a second, the more accurate way, and you guys can play around with this, the more accurate way to look at the results is to take the historical average rate, which is comprised of our deposits and our spending, and then every single month that this index, which by the way is tied to the SOFR, secured overnight financing rate. That's the index that the all-in-one is tied to. Other indices, guys, is going to be prime. You guys have heard that one. The Fed fund rate gets a lot of gets a lot of coverage these days. But this is the SOFR. So that's the index that this is tied to. So plus margin, right? This is, oh, I know what I was saying. Sorry. The historical, every single month that this index has been in existence has embedded into the simulation here. So the historical rate average is based on those factors. Okay. And in doing this and making this change, you'll notice it doesn't even move the needle that much. It's just a more accurate way to look at the potential interest savings. Okay. To my point, I think a second ago, I could be off by a month or two, but I think this number said 5.2 years. Now it says 4.9. So you get my point. It doesn't really even move the needle that much to adjust that rate trend. You guys do what you want. This is how I look at it. And like I said, there's another reason that I do it that way, and I'll show you in a second. All right, left to right. So we have 4.9 years is what it's telling us it will take this individual with these numbers to pay 400 grand in debt off to zero. Now, a lot of times you guys aren't going to use it for that reason. That's another conversation. But if these were static numbers, this is real. It would take 4.9 years to pay $400,000 to zero. Okay. 26 years left on our 30-year fixed, 400,000. Next up, we've got total interest, 72,000 and change versus about 144,000 and change of total interest left at 2.5% on 400 grand over 26 years. This is just the number of payments, 4.9 times 12, 26 times 12. That's what that is. And then finally, or not finally, we've got the sum. Sorry, the sum of principal and interest. These two numbers added together, 472 and change, 544 and change. And then finally, you've got the difference between them. So this example, this individual stands to save about just under $72,000 in interest by applying this product, this loan product, and this concept of velocity banking. Pretty freaking cool. All right. Now here's what I want to show you, and then I think we'll open up for questions. So let me tell you how I got here. So we're still in the results tab. Okay. In the pay down summary. All right. Left side is the all-in-one, right side is the 30-year fixed comparison. And in fact, anytime you screw around with these subtabs, if there's a side-by-side comparison, left side's always going to be the all-in-one, right side's always going to be the comparison product. I'm going to skip past the dollar amounts here, you guys. They're static. I want to focus our attention on these percentages and define for you what you're looking at. So all-in-one first. Average principal reduced annually. Based on our values, we're taking $400,000 and we are reducing that at about 20.3% annually versus our 30-year fixed mortgage is reducing at 3.8%. I'm asking a question, I guess, rhetorically, because you can't answer me yet, but most of you are aware, when you look at a 30-year fixed product, take the first 10 years or the first 120 months. How much of your payment, when you look at your mortgage statements, if you look at those, how much of your payment's going towards the principal? This much, right? It's front loaded because they want their interest. The banking industry knows that the average shelf life of a 30-year fixed mortgage, and we'll use an owner occupied as an example, is about 7 years before someone is refinancing to improve an interest rate or pull cash out, or they're selling it to downgrade or upgrade, whatever it is. So knowing that, right, the lending industry, they want, I mean, they're lending the money, they want their interest or as much of it as they can. So that amortization clearly works to their advantage, their benefit. And that's why this looks so paltry, 3.8 average annual reduction. Now we get into interest as a percentage of principal. If I take $400,000 and I multiply that number times 18.1%, I'm going to get $72,408. If I take $400,000 and I multiply it times 36.1%, I'm going to get 144,378. Okay. Now here are my favorite numbers on the page. Last three here. So we've got our 2.5% 30-year fixed mortgage. What this number is telling us, comparison loan effective APR, is that in order for 144 on the 30-year fixed mortgage, in order for this number to match this number, 72 grand, this 2.5% interest rate 4 years ago would have to have locked at 1.139. Sorry, you guys, my nose is running. Pretty cool, huh? I mean, it's when you see it in this from this lens, it's like, wow. And then the flip to that coin is, in order for the all-in-one to match, in order for 72,000 to match 144, we're going to have to average break-even average rate of 11.489. Now, this is that other reason I was talking about, 11.489. Remember that. That's why I like to see this as well. So 6.965 is the average, historical average based on the index, deposits and savings, etc. So if we know that that is our historical average, and we also know that the break even for the all-in-one interest accrual to meet or match what you have today is 11.49, that gives us a lot of comfort there. There's a big margin of error there, or spread, where interest rate fluctuation, etc., is to our advantage. Okay. Let me show you how to save this, and then why don't we open up for some questions? So when you guys, if you do this, if you decide to do this and you get to the end, save and share up here, there's your key code that you can save, okay? And then if you wanted to, you can PDF this, and all of the data points are in a PDF. All right, and if you remember back in that getting started, that's where you're going to put that key code. What's the deal with this key code? Does anybody want to take a stab at that? Is this the formula for Coca-Cola? I don't understand why this is such a complicated key code. Okay. All right, let's open up. Michael, do we have any questions in play that we can get into?
Yeah, we do have a few good questions. The one that I thought was pretty relevant was, let's see here. He had a question about, sorry about this, 1 second. Why is it not showing up? He had a question about whether the use of the income, driving incomes into this from your business and personal, would pierce LLC protection.
No, and it won't. If I'm understanding the question, let me repeat. And I think you guys can unmute yourself. So feel free, you guys. This is interactive, and that's why I like to do it live. So feel free to ask the questions as they come up. Okay. So I believe your question is, if I were to take my deposits from my business and put it into this, is it going to pierce the asset protection that the LLC affords me? No, this is your private banking account. An LLC for asset protection and piercing that veil, no one's going to have access to a checking account that you have. The LLC, as long as you've got it set up correctly, and you've got your registered agent, et cetera, in place, no, there won't be any issue. The only time that scenario could potentially be problematic, and check with your legal team, okay, is that if you are in a business where you're a fiduciary and you have a trust account, then it would be a problem. But otherwise, absolutely not. Now, your accountant is not going to like me for saying that, because it's going to make it very difficult if you're taking all of that and putting it in here. It's going to be harder for them to track and kind of do their bean counting. But what you could do is come up with the day, right? I need more details about the business, but if it comes in on the second day of the month and it goes back out on the 28th day of the month, that's still going to be far greater to your advantage. And that way it might have that that easier track for a CPA or accountant to make sure that they can see, what's coming in, the expenses, et cetera, et cetera. So there's ways around that, or to make it kind of equitable for you in saving interest and your accountant or CPA.
We had another question on how to do this if they have properties in an LLC.
Yeah, so you can't close this loan in an LLC, and the loan documents you sign stipulate you will not transfer it or do not intend to put it in an LLC. Do people do that? I'm sure they probably do. What would happen if it came up down the road that they put the property into an LLC, this all-in-one loan into an LLC? If it were to come up, you're going to be, it'll be your cost or expense to take it out of the LLC and put it back into your individual name. Will it come up? I don't know.
Would it
The loan
change? Are there
documents,
different business vestings that you could leverage?
say that again?
Are there different business, protection mechanisms like corporation, S corp, C corps?
Not for the, no, not for the loan, and certainly not for the checking. You could close title in a trust for that kind of anonymity and layer of protection, but LLC, per the loan documents you sign, are not allowed for the all-in-one. So for you investors, if the property is an investment, either put it into a trust for that purpose, or get an umbrella policy, $1 million liability coverage. There are ways around that too.
Once the loan is paid in full, what happens to the loan?
You have a line of credit. So, okay, let's dig into this. So let's say that you pay the loan off in record time and you have this free and clear line of credit. You have created an environment, you guys, where you have legitimately become your own bank. Depending on what your numbers are, you could have a $100,000 line of credit, you could have $1 million, $2 million line of credit. This is your line of credit. You're not pre-qualifying. Everybody's favorite pastime is the loan process and getting pre-qualified. You're not paying closing costs every time you want to harvest equity out of the property. This is your line of credit for, by the way, 30 years. Let me take a quick second and kind of get into that, because it's one of my favorite features of the all-in-one. So anybody that's had a HELOC, you know that you're limited in the amount of time that you can draw on it, right? 3 years, 5 years, maybe you get 10 years. That's probably the most common, is you've got access to draw on the line of credit for about 10 years, and then it shuts off, right? That access shuts off and becomes a principal and interest payment for the remaining probably 20 years or 240 months, right? 20 times 12, 240. Remember that number. The all-in-one is very, very unique in that you have access for 30 years. What happens is, for the repayment portion, because the balance can never be higher than the limit, right? The balance always has to be lower than the limit. Same with a credit card, right? You can't have more. The balance has to be lower, because that's part of the mechanics of repayment. In month 1 of year 11, so month 121, the limit will start to decline by a factor of 1/240th%. That 240 is representative of the number of months in that trailing 20 years. So the easy math example that I give in this case is, let's say that you started with a limit of 100 grand, okay? If the $100,000 were to be reduced by a factor of 1/240th, that's easy math. Now your limit is 99,760. That's your limit. Because your balance can't exceed your limit. That's how repayment works, very, very gradually, but you still have that access, which I just absolutely love. Very unique to the HELOC space.
Do we validate debt to income, and what's the maximum LTVs? And might as well talk about the differences between investment and primary with those in mind.
Yeah. Okay. So qualification metrics, we'll start with primary and then I'll move to non-owner occupied. So primary as a purchase, you can go to 90% loan to value. Primary as a refinance, 80% is max. Investment property is going to be 75% purchase or 70% refi on an investment property. Now, the investment property refi could actually go to 75 if it's what we call a rate and term, meaning that the spread between the starting balance, what you owe, and what the limit is less than $2,000. That would be a rate and term. You can get all the way to 75 in that case. More often than not, it's usually going to be 70 if it's going to be cash out refi. So those are the LTVs. Second home follows, by the way, second home follows owner occupied LTVs. The other guidelines, let's focus on the 3 big ones. You've got credit, assets, and debt to income ratio. Minimum credit scores for a primary residence is 700. Minimum credit score for an investment property is 720. Assets, reserves. This is a big one. The reserve requirement is going to range between 10 and 15% of the line limit. Well, which is it? Is it 10? Is it 15%? It's tied to the individual's debt to income ratio. Okay. But before I get into that, let me just kind of give you an example. Let's say that the line limit was 100 grand. 10% would be 10 grand, 15% would be 15,000. So whatever your line limit is, 10 to 15% is what we need to show in reserves. Now, those reserves can be just liquid checking, savings, money market accounts. They can also come in the form as from your retirement accounts. So 401ks, whole life insurance policies, self-directed IRAs, right? Those are all legitimate as long as the terms of withdrawal are appropriate. Those can satisfy the reserve requirement. Now, the debt to income ratio, let's take a minute and talk about this one. This is not an easy loan to qualify for, you guys. In fact, it's probably up there at the top of the list in terms of difficulty to qualify. And the debt to income ratio is really where most of that challenge comes from. So let me start by saying the max. 43% is the maximum DTI allowed for the all-in-one. Okay, versus traditionally we can go to 50% with most loan products, Fannie, Freddie, FHA, blah, 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 right? The all-in-one caps us at 43% DTI. Let me quickly quantify, go back to that reserve thing. So if you're at 40% or less in debt to income ratio, your reserve requirement is 10%. If you're 40.01 to 43, which is the max, you're at that 15% reserve requirement. Okay. Let me drill down into the DTI though, that 43%. So any kind of variable income. So for you self-employed people, for you people that have overtime or bonus or commission or a Schedule E, for us investors, those are all going to be considered variable income. And the calculation is a 24-month average. If you don't have a 24-month average, we may not be able to give you the income. Not always the case. It depends on what type of income it is, but it'll be a 24-month average unless the most recent year, let's just take 23 and 24, 2023 and 2024, okay? If 2024's return in that variable income space is in a decline from 23, that average is going to make the income bigger, better, right? They won't let us do that. So in the event that the most recent filed year is in a decline from the prior year, then it becomes a 12-month average. Clear as mud, right? So my point is that variable income is looked at very harshly, okay? And the DTI is reduced to that 43% spot. Otherwise, just W-2 income, straight ordinary income is just the gross income divided by 12 months and or year to date. We can also take, for those that may be on the edge of not qualifying, we can also do something called asset depletion. So if the income documentation that you have doesn't quite get you there in the DTI category, we can take, let's say you had $1 million in a brokerage account or something. We'll take 120 divided by that face value, whatever that asset is, and that income, that number can be used as income to help qualify. I think I covered most of it. Credit, yeah, I think we got that.
One more piece here. What is the timeline to close on it, and how much does it cost traditionally?
Yeah, good questions. Very good questions, you guys. We're cooking with fire here. So the timeline to close, I just recorded a video about this actually. So pre-qual, we're pretty quick, 2-3 days, depending on how quick you are at getting us your vials of blend DNA samples. But post pre-qual, you can expect to take about 45 days to close the all-in-one. This one does take longer than most traditional, 2 to 4 weeks. So expect about 45 days to close on the all-in-one. And then more importantly than that, I get this question a lot. Post-closing, okay, once you've closed, it's going to take another 4 to 6 weeks, sometimes as long as 60 days before you gain access to the line of credit, the banking features, before you get that onboarding email and letter that say, welcome, da-da-da. So just know that from beginning to end, pre-qual to gaining access can be 3 months, 3-4 months. Not usually, but I just want to set that correct expectation. Okay, I think that this is a great segue into closing costs. So once people connect the dots, once they really understand what's at work here and how the all-in-one really functions and the light bulb goes off and they really get it, the very next question, the follow-up question, this was true for me too, is what's the catch? Okay, what's wrong with this thing? Where is the fine print? For those of you that weren't here initially earlier in the call, I've been studying this loan and teaching this loan for 18 years. Okay, I know it like my own face. And early on, I had that question, like, what the heck is wrong with this thing? There's got to be something. So I promise you, I've looked. I have turned over every layer to find out where is that potential pitfall. The only thing I have identified as a barrier for entry are the closing costs. All right. This is not a cheap loan, not for the faint of heart. This is an expensive loan, every much as expensive as any traditional 30-year fix that you've ever gotten, maybe even a little more. So to give you kind of a baseline, you can expect all the traditional third-party charges, title, escrow, appraisal, all of the transfer taxes, whatever, depending on where you live and where the property is. So all of that stuff is still going to be applicable. And you're going to be paying between typically, sometimes a little bit less, but this is the typical range, between 3 and 4% of the initial draw. Now pause. Okay, for those of you that are choking on your Diet Coke when you heard 3 to 4%, I need to make sure you're aware that is based on the initial draw. So you have some control over that. Let me explain. So you think about the line limit, right? You get approved for $1 million in a line limit, but you only owe 350,000. Okay. The points between 3 and 4, and I'll define how do we get to that, where in that spectrum in a second. But the points are going to be on the lower draw, not the limit. Okay, 3 to 4% is going to be based off the draw. And how you may have some control over that is if you have additional funds available to you, assuming you hit the minimum draws, there are minimums, okay? But if you have some additional funds available to you, you could bring in the difference. I'm going to give you an example so that you guys don't have to just guess. But you can bring in some additional funds and drive that initial draw lower so that the closing costs are less and the interim interest will be less. Let me tell you what that means, and then I'll give you some examples. So interim interest, it applies to any mortgage from the day that you close until it's onboarded to the servicer, in this case, the banking features, et cetera. There is a window of time. I called it 4 to 6 weeks approximately, that there is a balance accruing interest. Interest is accruing on that amount. Okay. So every day interest, by the time the welcome letter gets to you, your balance is going to be that many days per interest, and that balance, that many days more in the balance when you get it. Okay, that's interim interest. That is, it's true with a 30-year fixed. It just comes in, you probably prepay it within your closing. I won't go down that rabbit hole. Just know that if you have additional funds available to you, okay, 50 grand, 100 grand, whatever, and you can bring that initial draw down, you're going to save in closing costs and that interim interest. Let's do a quick example. So let's say that you get, let's just keep using $1 million as the line limit. And let's say that your balance is $500,000, but you've got 200,000 over here that you could get your hands on for even a short period of time if you wanted to, and you brought that to the table. So, and let's say that your points are 3.5. Okay, 3.5 would be based off of 300,000. Do you guys follow that? Let me say it again. Your current mortgage is 500 grand. You have $200,000 that you can bring to the table to cover the spread between what you owe, what we have to pay off, and what we want to bring the initial drawdown to. 500,000 is what you owe. You've got 200,000. 300,000 is what you're going to draw on the line. You're covering that spread. So the points would be based off that 300,000, right? That's how that will work. Any other questions about closing costs? It's usually one of the hotter topics. Now, let me, one other thing. Sorry, Michael. Let me just say one other thing for those of you that are sitting here thinking, in the simulator, I'm still sharing, I think, right here, you guys, and the math will not lie. Okay, trust the math. Right here in this CSV, okay? More often than not, those individuals that this loan makes sense for, regardless of the closing costs up front, more often than not, whatever that number is, they end up saving that in interest in the first 6 to 12 months of having this loan. Okay, so make sure that you do the math. So let's say your closing costs are 20 grand. Okay, you can look at this CSV for your numbers, and in these columns, you should be able to ascertain, I think it's K, yep, the all-in-one's right here. There's your comparison. Columns K and P, I believe it is. You'll be able to delineate for yourself how long will it take you to recapture 20,000 in closing costs in interest savings. The math won't lie. Sorry, Michael, go ahead.
I just had a question, like costs is maybe based on value over time. So how would an investor who's buying properties take advantage of this, not to just save money on their current home that they're paying interest on, but future investments?
Yeah, I'm glad you brought us back to that. So I think I started this conversation by saying we're really going to focus for now on the interest savings, right? We can tell, I mean, that's nothing to sneeze at, you guys. I mean, right now we've got $72,000 of interest potential interest savings, that's amazing. So when I do these simulations and I see that there's, 20,000 or more, then I like to have that further conversation, because this is just piece one. And for me, in my opinion, that's great. But I think that's secondary to what the all-in-one really, the impact of the all-in-one. So thank you for bringing us full circle on that, Michael. You now, especially for investors or anybody that wants to have that freedom and that line of credit. So I said a moment ago that you have created an environment with the all-in-one where you become legitimately your own bank. You can draw on this. Let's just run a scenario, okay? So pay down table. We're in the results tab. Pay down table right here. Left side's the all-in-one. There's our comparison. Let's say in month 14. Okay, here's our years, here's our month. In month 14, I have access to $78,000 of equity, and this is just at the 400,000 mark, right? Just as a quick sidebar, we didn't even set this up to take, because this individual would, if they qualified, would have access to an $800,000 line of credit. We're looking at the $400,000 balance that would be paid down. Let's go back here. Let's go back here, pay down table. So in month 14, this dude has access, has paid down this much, that if he or she wanted to, they could draw $78,000 to do what with it? Well, whatever they want. But let's say it's for investment purposes. Let's screw with this for a second. Let's go back to spending. How much time do we have? Do we have more questions? Do I want to go into this, or do we want more time for questions?
There are a few more questions, but
Okay.
maybe a short look at this would be good.
So I'm on the spending tab. Okay, I'm taking $60,000. I'm pulling $60,000. I'm forecasting in month 14, and I'm going to use this, and I'm going to buy an investment property. Okay. Now, I said earlier, and it was probably a little confusing, if you do this, I believe you should add the deposit as it relates to the spending of that capital. The problem in doing that, though, you guys, is that this forecasts, it's going to take it in 14 months. Okay. In the deposits, if I put in, let's say I bought I put $60,000 down on a $250,000 purchase, and my rents are $2,200 a month gross. Okay. This money is going to sit there for 29 days out of a 30-day billing cycle, same as the others. Okay. I'm not even going to change. So this was $6,000 before. Okay. I'm not even going to say I have cash flow. I'm just going to say that the property is a break even. So let's get this back down to, okay, I've got $118 a month of cash flow. Now, if that were true, if this were a true scenario, I wouldn't be buying that property, right? The cash flow for me personally would need to be more than $118 a month. Anyway, you guys should get where I'm going with this. The problem with this scenario is that $2,200 is happening today. The $60,000, excuse me, is happening in 14 months. The numbers are not going to be that far off. They're off by a few months probably, but not anything significant. I'm going to do it this way. You guys do it how you want. Okay. So now we have changed our dynamic here. Now it's 5.7 years to pay off. We've reduced the amount of interest that we can save. However, what do we have? We have an investment property that's appreciating ideally, and it's depreciating in our taxes. We've got some tax incentive and that long-term burn or benefit of that asset class. So for me, this is where it really starts to get cool, is in that access, not just the interest savings. These are the kinds of things that I after the part one and identifying, yeah, this is a good fit for this individual, then I start to get into some of this higher level stuff and strategy and, future financial literacy and how to really come up with your plan for what's next, right? That freedom, that financial freedom. What else we got, Neff?
Well, so we've got some great comments and suggestions. A good segment of the people watching would like to do another presentation that talk more in depth about the tips and tricks of using the all-in-one after the loan has closed. Cool. What investments really work to build net worth, cash flow, and portfolio, and how the all-in-one can speed that process up and reduce costs over time. So we're just collecting some really great feedback on managing sort of the after the closing event when they put this in action. Now, I would like to just point out, because we're kind of moving here to the end, that there is an opportunity for people on this call to go through a master class on the all-in-one. Caeli pointed this out in the very beginning. It is going to be on the website. You go to ridgelendinggroup.com, click on the all-in-one category, click on the masterclass, and to get time with Caeli one-on-one if you want to go in depth in person with these, what we just ask is that you go through the masterclass. There's a podcast to listen to that dives really deeply into the subject. There's some questions, and then there is the simulator at the very end. Your code will unlock access to Caeli's calendar. Well, she'll give you that one-on-one time.
And it's been very, very helpful. Yeah, we just had that launched recently, and I feel like people are really benefiting from having that one-on-one. And this is what we do, kind of what I just went through, but we just use your numbers. So yeah, you guys, please take advantage of that if you think that you'd be a good candidate for this, even if not now, maybe in the future. If nothing else, you really want to start educating yourself about this concept, whether it's the right move for you today. Having the information is, I mean, what's wrong with more information? Nothing, right? So I would take some time and really start to understand this if you don't already.
Caeli, one last question here. Mustafa asked to clarify the point on reserve requirements. And I think maybe what he wants to know is when you said 10%, 15%, how does that actually calculate in payment or like the amount that you have to have in your bank?
Yeah, so whatever your, Mustafa, thank you for the question. Whatever your line limit is, you were approved for, right? So let's say that your home is worth $1 million. Okay, that's the appraisal that came in, and it's your primary residence. So you have been approved. Your qualifications allow you to get the maximum loan to value at 80% of $1 million. That's 800,000. I don't even try to do mental math anymore, you guys. I'm not going to even try. I can do the 10% one. So if your DTI was 40% or less, 10% of 800,000 is going to be 80 grand you need to show in reserve. You're not bringing that to the table, obviously. It's just what we need to show to qualify you in the reserve category. If you are 40.01 to 43% in the DTI category, that 10% reserve goes to 15%. So what is that? 120? I was actually going to put it into my calculator, but I don't think I need to. So 120, I'm going to do it anyway. Like I said, I stopped doing mental math a long time ago. Yeah, 120. You can teach old dogs new tricks. So does that make sense, Mustafa? So 10% or 15% of the limit, of the line limit, is the reserve requirement that we're going to need to satisfy to get you to qualify. And that is based on the 10 to 15 is based on the DTI.
Can that reserve be used in closing to drive down the loan amount?
No,
or
good,
balance?
very
Okay.
good question, Michael. Thank you for saying that. So if you, let's say that you have a 401k that you can draw from, and there are limits, but let's just say it's limitless. Let's say you've got $300,000 in your 401k. And we need to show 120 for the reserve. And you can draw the difference, or you were thinking you could draw the whole thing. You can only draw the difference between the reserve requirement has to be left in place. And then if you can get cash to bring that initial drawdown to save in the closing costs and that interim interest space, the difference is acceptable, but you must leave the reserve requirement in place, whatever that face value asset is. But if you have other assets, that would be fine.
Oscar in our chat here has been very patient. He's asked a question a couple times. I want to make sure we get to him. He asked the question, how does taking out a loan against the all-in-one affect the amounts needed to pay the loan? Considering we have a larger loan amount against the line, does the minimum payment amount increase?
I'm going to need him to maybe say that again, but let me, on that topic, I want to just comment something. There is no payment on the all-in-one, guys. Okay, and while you're rolling your eyes at me, because that's what I did when I first heard that, let me quantify, okay? There's no payment due on the all-in-one so long as the balance and the limit have an appropriate spread between them. The only time a payment, because every deposit, every cent that you deposit into this account works like a payment, but the only time a mandated payment is required is when your balance is about to exceed that limit. So imagine for a minute your 30-year fixed mortgage. What happens if you choose not to make a payment for the month? You're jacking your credit and they're coming for the keys soon, right? This is an open-ended revolving line of credit that is yours to do what you want with. So so I know we're probably going to go a few minutes over time, but I think this is very valuable because there's so much there's so much density in here. I don't usually get an opportunity to talk about this piece of it, one of these other value adds. So let's say, God forbid, something were to happen and all sources of income that you otherwise had access to dried up like that. the whole household, no income whatsoever. Well, you have this all in one, and it's got a limit of $500,000, and your balance is 200,000. There's a $300,000 spread there, right? If you chose not to make a a deposit for a month, what's going to happen? They're not coming for the keys. The only thing that's going to happen is interest is going to accrue on that 200 grand balance. So the easy math that you would do there is you would take your daily balance for 30 days times the interest rate. Okay, let's say the balance is $200,000 every single day for 30 days. You take that number times 8.34 for the month of August, divide that by 365 days in a year. Now multiply it times the 30 days again. That's how much the 200,000 is going to increase by in the first day of the next month, the following month, and so on and so forth. So if something were to happen, a payment is not due as long as that spread is there. And even further, let's say that you needed to draw some of the equity to live off of for a month or two until you get back on your feet. That is for you to choose, right? That safety net becomes really attractive when you think about the unthinkable, that life should happen. So I think that probably answers part of the question.
He says thanks, it does. Yeah.
Okay.
Just one last thought on that, guys. From an investor perspective, cash flow is king. We all know that. So if you can control your cash flow, this is that's an amazing opportunity to not have a required payment, quote unquote, cash deposit taken out of your bank to make that on a monthly basis.
Yeah, I think as you guys continue to educate yourselves about this, you're going to find more and more opportunity to be impressed with it. I'm glad you were here today. You'll get the recording. Please do that all in one. If you need to reach us, 855-747-4343, 855-74-RIDGE, info@ridgelendinggroup.com. Our website's ridgelendinggroup.com. And I hope to be seeing and speaking with each of you soon. Thanks for coming.